Hello, and welcome to the InRay podcast channel by Control Risks. Today, we're going to talk about enemies of M&A, fraud risk in international corporate M&A transactions. I am Martin Tornberg. I am head of financial sponsors and private markets at Control Risks for EMEA. And with me today, I have Hannah Harrison, who is the managing associate of the global investigations team at Adelshaw Goddard LLP, and Oleg Kozlov, who is our associate director in the investigations and forensic accounting practice here at Control Risks. Welcome.
Thank you, Martin.
Hi.
In a world in which seismic geopolitical shifts and policy volatility are impacting markets, navigating M&A transactions has never been more challenging. I would say that investors today really demand that every deal be executed with the utmost security and precision. And perhaps that an increasingly important aspect in that is the need to guard against financial crime, whether it's fraud, corruption, or money laundering, because any of those could derail even the most promising deal. If we look at data that has been published by the Association of Certified Fraud Examiners, each year some $5 trillion could be lost due to fraud globally. And a proportion of that, of course, can be attributed to M&A deals. M&A deals account for about 3 to 5% of global GDP, the value of those M&A deals. So it's natural to assume that a proportional amount of losses could be involved in those M&A transactions. But it could be even more because M&A transactions are complex. There's often a case of having asymmetric information. And we very often see that fraud is the reason why deals fail. It is also very problematic that it's difficult to estimate losses in M&A cases. Very often, the alleged losses are based on estimations of future synergies, which of course are yet to be realized. But importantly in this case is that they are often based on historical financial information. And if that historical financial information is riddled with fraud, then it's very difficult to execute an M&A deal because that's the very basis of that transaction in the first place. In this episode, we will explore how companies can identify and mitigate these risks, ensuring that their M&A processes are both seamless and compliant. And starting with you, Hannah, looking at today's policy volatility, for instance, in the US, but also in Europe, which might take a different tack when it comes to certain of these aspects. And if we start with the sharp end of the stick, the enforcement aspect, which is something, of course, that anybody involved in an M&A deal would be most concerned about. Can you give us a little bit of an overview how the difficulties for businesses to navigate this environment is today, particularly perhaps when it comes to cross-border M&A?
Absolutely. Macroeconomic developments make it really difficult for businesses in terms of consistency. And what we've seen with Trump halting the FCPA in February and then republishing the FCPA guidelines recently, businesses are finding it really challenged to keep up with all of these changes. Our clients are particularly finding it difficult to navigate the differences between the US approach and the UK's and Europe's approach, which are differing. So the new FCPA guidelines, which were only published a couple of weeks ago, so we're still trying to navigate how these are going to impact our clients, basically sets out that the US is going to have a particular focus on where US companies are the victim to corruption from other outside entities. Now, this is a change in direction, and it's not a direction that the UK and Europe are taking. So if we take a look at the UK have recently set up an alliance with France and Switzerland, and they're setting up a cross-border alliance in order to navigate and share information, set up formal structures for combating financial crime across their countries. We've also got the failure to prevent fraud offence, which is coming in September, which we'll come on to talk to in a bit more detail. And we've also had some UK guidance called the Corporate Cooperation Guidance. And what that sets out is that if a company self-reports for financial crime, then they will be invited into deferred prosecution agreement negotiations. Now, this is the first time there's been an explicit confirmation that there will be an invitation. And it's not something that the US are doing. The US have a slightly different approach where in order to receive a declination, which is the Department of Justice declining to take criminal action against a company, self-reporting is a consideration, but it's not a guarantee for one. So we are looking at differences between the regimes, and it is quite difficult for our clients to be navigating these changes.
I can imagine so. And what I hear from you is that with these different regimes and the changes within the regimes, the companies, they really need to stay on top of these things on a kind of a ongoing basis, and particularly perhaps have to be diligent in their work, because if they want to be able to take advantage of these deferred prosecution agreements or the declinations, then they have to self-report, and to self-report, presumably you need to know what's been going on. Would that be correct?
Absolutely.
Right? Thank you then, because then I want to ask you, Oleg, if you can add a little bit of color from our sort of risk perspective in terms of these developments.
Yes, surely. When the FCPA enforcement halt was announced, it sent clearly a very mixed signal. But in my opinion, and in conversations I had with clients, the business community did not take it seriously. It did not take it as a license to scale back compliance. And there are obvious reasons for that. First of all, the halt was temporary, and we're seeing there is a change in that policy. And second, there are local authorities who enforce corruption prosecution. So there is no point in reducing the efforts to mitigate bribery risks. So to sum up, it was business as usual for most of the companies, large corporations who are having their anti-corruption compliance management systems in place, not really affected by that change. And as I hear now, with the recent change, the halt may not be actual anymore.
Yeah, that's what we've heard. And thank you both for those insights. So just to sum up then, from my perspective, these enforcement mechanisms certainly remain. And we have to be vigilant and navigate these frameworks because we don't know what other changes the policies can be subject to going forward. Now, I want to pick up on one point raised by you, Hannah. You mentioned that the UK's new failure to prevent fraud offense comes into force in September. Is that right? Yeah. Now, that comes with criminal liability for organizations that fail to prevent fraud, right? But not only for what they do, but also fraud committed by what they call an associated person. What are your thoughts on how this could impact M&A in particular?
Well, there's a few things to unpack. So if we start by saying not all companies will be caught by the offence, there is a definition within the Act that says only large organisations will be caught. So whilst that might affect a lot of our clients, it is a key consideration when we are advising and doing our initial analysis. So particularly for M&A, what could happen is an entity is smaller than the requirements for a large organisation. It enters into a merger, becomes in scope, or it acquires a smaller target entity, and that also brings it into scope. So it's very important pre-acquisition that an analysis has been done as to whether you are in scope before or you will be in scope afterwards. The second thing to think about with M&A transactions is often the compliance frameworks of the larger acquiring entity and the smaller target entity won't be in alignment. We often see that smaller target businesses don't have very detailed compliance frameworks in place. There's also a difference between countries. So perhaps if you're acquiring an overseas entity, then they might have a different assessment of financial crime, criminality risk. So there are definite things to keep an eye on when you are looking at target entities. Now, if we move on to the guidance, so the Act hasn't come into force yet. As you said, it's the 1st of September 2025. But what we do have is some quite detailed guidance from the government, which allows us to take a view on where they're going in terms of enforcement. And within the guidance, there is a defense. So it's called the reasonable procedures defense, which means if a company has reasonable procedures in place, then it has a defense against the offense of failure to prevent fraud. And the guidance sets out quite neatly that there are 6 principles which you should use when you're building your compliance framework if you are in scope. And some of these we've seen with the Bribery Act already. So you've got things like top level commitment. So the board making very clear that there's a zero tolerance approach to financial crime. You have monitoring, so risk assessments on an ongoing basis. You have communication, training for all employees. And I think a very important one for us is the due diligence aspect. So due diligence is one of the 6 key principles. And then the guidance again splits this into 2 sections. So you have the pre-acquisition due diligence and you have post-acquisition integration.
Right.
And what this means is before a merger or an acquisition goes ahead, companies need to do very detailed and prescriptive due diligence on target entities to cover some of the things we've already talked about: difference in frameworks, difference in culture, difference in expectations of staff. A detailed gap analysis is very important. And the guidance does recommend that best practice is using third-party M&A tools in order to conduct the risk assessment and the gap analysis. So
is that to avoid bias, you think,
or just to make sure it's done in a lot of detail, just to make sure that a specialist is looking at this and it is taken seriously. It's best practice. It's not required. It's just a strong recommendation. And then we have the post-acquisition integration. So for a merger or acquisition, it's very important, and the guidance is really clear that as quickly as possible, the target needs to be integrated within the larger framework. So this includes dynamic risk assessments. Again, we're looking at the gap analysis between where the new target and the existing entity don't line up. Key part is training as soon as possible, not leaving it to months down the line. A lot of this can happen pre-completion as well. Completion doesn't need to happen to start revising the policies and procedures, to start talking to people. The integration is a very key part of making sure that the target entity is adequately sort of wrapped up into the large organization.
Thanks. That makes a lot of sense, and that was very, very clear. And so what I take away is that the last bit you said, that the work doesn't stop at closing. You've done your pre-due diligence, but actually there's another element, which is the integration bit that has to align to best standards post-deal. And I guess it's an ongoing commitment. You can't just sort of do it once. You have to sort of keep making sure that you're compliant on those aspects.
Yes,
right?
very much so.
Very good. Turning to you, Oleg, we've heard about this FTPF in the UK, but how does the rest of the world look at this? Are there other countries that are looking at similar types of legislation that would criminalize the failure to prevent fraud?
Right. The UK is a first mover in this instance by introducing a failure to prevent fraud corporate liability. There are instances in other jurisdictions of failure to prevent bribery, for example, in Hong Kong, in Australia, in Ireland, but not failure to prevent fraud. There are extensive requirements from EU Corporate Sustainability Due Diligence Directive, but it also does not include such an element as failure to prevent fraud. I would say that a lot of jurisdictions are currently considering such an option, and there are discussions ongoing, and they are closely monitoring the situation in the UK, and I think may be ready to apply a similar model in their respective jurisdictions.
Okay, very good. And we talked a little bit about the different aspects of M&A in respect to failure to prevent fraud. And one word that we heard was associated persons. Oleg, can you perhaps go through that aspect of it and mention maybe another few key aspects of the link between M&A and the failure to prevent fraud offense?
Yes, absolutely. There are a few topics that I would highlight in the context of M&A practitioners considering failure to prevent fraud. Associated person scope is very broad, so it can include joint venture partners, consultants, other third parties the target is working with that immediately become your risk.
And can I jump in there as well? Because I heard about the case where the seller was sort of convicted, and this must have been about fraud more broadly in the M&A context, because the seller was a fund and they were selling a portfolio company, and the portfolio company's CFO had committed fraud, and that negated the knowledge of the seller defense. And that to the knowledge of the seller, there's no such X or Y aspect happened. But because the CFO was involved in the deal, his knowledge was deemed to be part of the seller's knowledge. So that to me means that you have to go quite broad when it comes to these associated persons. Would that be correct?
Yes, that is a very good example, and this is true. So the advice would be to ensure that in the contracts there are clauses related to fraud prevention and also audit rights. And as we're talking about contracts, this is another topic I can stress. So with the new failure to prevent fraud, you may need to revise your SPAs, different contracts related to M&A deals, in order to include the phrasing that is actually used in ACTA. So, for example, not just fraud, but fraud benefiting the organization, in order to mirror the language used in the new legislation. Another topic I would highlight is policy integration plans. So integration may take time. It can be a complicated process. And it is very important to set out strict timelines and owners of the risks. For example, you can think of appointing a fraud prevention officer. It can be a role fulfilled by a legal counsel or a compliance officer as integration processes. I would also make another point about senior manager onboarding. As we know, with M&A deals, there is a tendency to invite new directors, new top management. They never have time for training, especially compliance training. So it is important to have concise and clear training for the new management about the reasonable procedures, and also to document this training in case you need it during any kind of further reviews, or this can be also treated as reasonable procedures, having training in place.
And just to pick up on that, you mentioned new incoming executives, and we know from a private equity perspective, that's certainly the case, that there's a big turnover in management. But also in a corporate merger, I would imagine that you get people from two different organizations, which may have different understandings, to your point earlier, Hannah. So then the training would go towards making sure that everybody has the same basis and same understanding of what the standards are. Is that right?
This is absolutely true. Yes. And this also brings me to my last point, that as the organization changes, if we're talking about corporate M&A, the combined group can enter new markets. It can offer new products or services, which introduce new risks. So it is very important to keep ongoing monitoring of fraud risks in order to ensure that the new entity in the new group structure continues ethically, business-wise.
And just to add a point to that, you mentioned the case where the criminality was attributed to the CFO of the company. as you mentioned, senior managers might be brought in during an M&A transaction. What ECTA does is, so the Economic Crime and Corporate Transparency Act, it lowers the threshold to a senior manager level. So senior managers, their criminality can now be attributed to the company.
Right.
Previously, it was very difficult to find companies corporately liable because it was only really board level who had the adequate control over the company. Now the threshold has been reduced to senior managers who have control over part or all of the organization. So the standard is much lower now, and that is something that you really do have to think about in terms of M&A and training, especially, and onboarding, that the threshold is lower for attribution.
What I take away is that the fact that the associated person scope is quite broad, and like you say, the thresholds for responsibility has lowered to kind of a level below the board, or even 2 levels perhaps, I'm not quite sure. That really impacts how you have to look at it. And the only way to be outside of this is if you're not a large corporation, so you're not caught by it. But as we heard, a combination of 2 companies could make you bigger, so then you would be caught anyway. So that's on the one side. And the other side has to do with the processes that you have to think about, the policy integration plan, the compliance policy integration plan, and the onboarding of senior manager, then both on the sort of very senior level, but also on this level once below, and then keep doing that. And I think that aligns quite well with sort of the overall M&A process steps. So I guess the silver lining is that these aspects will slot into the M&A process as led by legal advisors or by risk advisors as the process continues, right? The companies involved in M&A sort of make sure that this module is covered as they go along. Is that right?
Yep.
Yeah. Great. Then I think the next thing I would like to ask you both is to illustrate this with some examples. So, Oleg, turning to you first, can you perhaps describe a situation that you've been involved in where these sort of issues have come to the fore?
Yes, surely. So one time I was managing an enhanced due diligence of a medical center in Eastern Europe for a medical devices company, which were doing a corporate M&A transaction. And looking at the vendor payment list, I spotted repeated payments to a sole trader. And the description for these payments were transportation and then computer repairs, so seemingly unrelated services. And when I asked for the supporting documents, there was little support. The invoices were either missing or missing details about the services. We had a few interviews with top management of this medical center. And during one of the interviews, the CEO admitted that this sole trader returned part of the money that he was receiving in cash to form a mini slush fund for this medical center. We were told that was done for ad hoc, immediate petty cash expenses, but you never know. This is a huge corruption risk from any regulatory framework point of view. And that was also coupled with other red flags, such as family members on payroll, lack of policies, lack of compliance trainings, and generally weak controls. So we put this all together in the report, which was used by the acquirer to formulate a detailed post-acquisition plan to mitigate these risks and to bridge these gaps.
That's a fascinating example, and I'm sure very representative of what goes on out there. But for our listeners who might be practitioners and who want to apply the learnings from this case in their future work, what are the sort of the key takeaways as you see them?
The key takeaway for me is to conduct enhanced due diligence when you consider the risks could be high. I know that pace of the transaction is critical in M&A deals, and you do not always have the budget and time to conduct this enhanced due diligence. But if there is a suspicion that risks are high, a deep dive due diligence is of good valuability.
Sure, absolutely. And a similar question to you, Hannah. Do you have a good example of how these measures would be applied and how what learnings we can take out of that example?
Yeah, absolutely. We obviously don't have any cases yet directly for the failure to prevent fraud offence, but if we look at a failure to prevent bribery offence, there was a deferred prosecution with the Serious Fraud Office in 2021, and the two entities were called Tetris Projects and Blue Solutions. And what had happened was they were an office refurbishment company, and Blue Solutions, in order to try and win a series of bids they were tendering, offered personal payments to a project manager on the other side.
Wow.
So in total, there were 5 contracts that Blue Solutions were bidding for, and they won 4 of them. And between March 2024 and July 2016, the contracts were worth about £11.5 million, so a significant amount of money. Now, the two companies were acquired in August 2015, so right in the middle of the improper conduct. They were brought within a global real estate firm. And during the due diligence exercise that was conducted on the target entities, nothing came to light about the improper conduct. It wasn't flagged, no red flags. The transaction went through, it completed, and it was only a year later, so in August 2016, when the global company did an internal audit to look at the success of the acquisition, that it found evidence of these improper payments, which totaled about £500,000.
Wow.
Now, the company then had to self-report under the Bribery Act 2010.
This was the acquirer self-reporting.
The acquirer had to self-report. And the SFO opened a huge investigation into all of the subsidiaries because the two acquired entities had been brought under the umbrella of the larger company. And in the end, the DPA was settled against Tetris and against Blue. And the financial penalty plus the disgorgement of profits, so the amount of profits that they made as a result of the improper conduct, totaled about £2.5 million. So this was a huge hit for an acquiring company, which has bought two companies and then found itself with a huge financial penalty and a deferred prosecution agreement, which has a lot of other compliance mechanisms in place, you know, a 3 to 5 year regime, where it has a series of tasks that it has to complete. So I think it's just really good example of why we need to take this seriously when it comes to mergers and acquisitions.
Yeah, absolutely. It's a great example. Both your examples are great. I think the guidance there is clear. When you're acquiring an entity, you'll need to work carefully on the pre-acquisition due diligence, and as we said before, on the post-acquisition integration, because these highlights really, these examples, I should say, really highlight just how challenging, but also crucial it is to uncover these fraud risks, so that you don't get saddled with these types of penalties, taking it back to the enforcement that we started our discussion with, and new legislation such as the UK's failure to prevent fraud and in other jurisdictions. The mitigation against this really comes down to doing your due diligence thoroughly, having the on-the-ground insights that you need, and let's say a sort of a proactive compliance culture, perhaps, right? It's important in general corporate life, but even more so in M&A when you're taking on an entity that you haven't really had control over before. And that was really all we wanted to talk about today, wasn't it? Yeah. So thank you all for listening. And many thanks to Hannah Harrison from Adelshaw Goddard and to Oleg Kozlov from Control Risks for your excellent insights. Thank you very much.
Thank you.
Thank you.